Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, once again, I'm glad to be here with all of you. I'm hoping that all of you are taking good care of yourselves and that you're maintaining the social distancing and you're taking care of your families. This is episode 111 of your Tax-Free Life Retirement Podcast. So once again, I'm excited to be here with all of you. And today, obviously, I've been doing a lot of podcasts for the past 2 years regarding different topics of retirement planning, tax planning, insurance protection, supplemental retirement planning, and all sorts of different things that are very critical for all of you as you start to look forward into the future, and most important, as you start to prepare for retirement. So today's episode, once again, is episode 111, and it is called, I Have Never Met a Widow That Did Not Believe in Life Insurance. And you have all heard me talk a little bit about this, but in reality, it is true. I have never met a widow that did not believe in life insurance. And over the past 30 years, I have delivered a number of death benefits to a number of my clients that have passed away along the way. And I can tell you that I have experienced what life looks like after the loss of a family breadwinner. Some of my clients were properly protected. Others, although I had recommended the right amount of insurance based on human life value calculations, which I'll discuss in the next few minutes, they had decided to opt in for something less than that. So I have had a lot of experience in dealing with my own personal clients as to, what life looks like before and after the breadwinner passes away. There are a couple of things that I can share with you regarding life insurance that I think you will find interesting because at the end of the day, it is very true from a business and from a personal perspective. And what I can tell you is that no one ever dies at the right time, period. I have had clients of mine that have died in their mid-40s. I have had clients that have died in their 50s, 60s, 70s. My oldest client died a year ago, just shy of a year ago, and he was 89 years of age. So no one ever dies at the right time. I don't care when you die and when that time is going to come. No one ever dies at the right time because there's always something left undone. So I encourage each and every one of you to take a look at your lives and try to do as much as you possibly can and enjoy it because, once again, tomorrow is promised to no one, and no one ever dies at the right time. Now, the challenge is that, once you're gone, life goes on for your immediate family. And that would include your spouse, if you happen to be married, your surviving spouse. It could include your children and grandchildren. The clients that I have had in the 40s and have passed away, I think perhaps 2 or 3 of them, had small children still. So the impact to the family unit is very, very high and very critical from a business perspective. Not only does life go on for the immediate family members, so do the bills and the expenses. Because once everybody leaves the cemetery or the funeral home and they wish you the very best, very few of them are ever going to come back to you to make sure that you're okay. And how can they help you and your family financially in your time of need? Now, no one can replace the sentimental impact of losing someone that you love very much, but you can replace the financial challenges if you have the proper coverage in place in order to do that. Now, I want to talk a little bit about why I have never met a widow that did not believe in life insurance, because that's a topic that I'm covering today. So I wanted to just give you an introduction. on the importance of family protection in your personal life. When you look at life insurance or asset insurance or life assurance, as I like to call it, think of it as money in escrow. And escrow closes the day you die. Now, as you very well know, based on all the podcasts that I have done in the past, life insurance contracts have a number of features. They have living benefits like cash value, long-term care benefits, supplemental retirement benefits, education funding benefits. But this podcast today is about the death benefit features of life insurance. So I'm discounting everything else that comes with a life insurance contract because I just want you to concentrate on the death benefit, at least for this podcast. So think of it as money in escrow. And escrow closes the day you die. So the minute that you die, the insurance company is going to step into your shoes and provide a financial guarantee that you had purchased prior to your passing and that will be provided to your family at that point in time. Basically, when you purchase a life insurance contract, if you think about it economically, all you're doing is you're buying much needed money at a discount, and you're buying it at a discount rate. In other words, you're buying dollars and you're paying cents on the dollar. So if I were to offer you, let's say, Amazon stock or iPhone stock, if you could buy stock in Apple, and I offered that to you at a 97%, 98%, 99% discount, how many of you would actually buy those shares, and how much of it would you buy if I give you that at a discount? Well, life insurance is the same thing. You're actually buying dollars. Life insurance is nothing more than purchasing dollars at a discount. Another major issue with life insurance, and another major benefit of life insurance, is that it provides a known amount at an unknown time. You just don't know when you're going to die. You could have a short life, you could have an average life, or you could have a long life. But regardless whether your life is short, average, or long, life insurance provides a known amount of money at an unknown time. It's actually fairly similar to a pension or an annuity, because you know exactly when you're going to be collecting that pension. You know exactly how much money you're going to be collecting. And the same thing happens with an annuity contract, where based on whenever you're going to pull the trigger, you know exactly what the amount that you're going to be receiving will be. Now, the difference is that in a pension and an annuity, you know when you're going to be retiring and you know when you're going to start collecting the benefits. But in a life insurance contract, you just don't know when you're going to die. So therefore, it will provide a known amount at an unknown time in the future. One of the major benefits of a life insurance contract is that it kind of repairs all your previous financial mistakes. And believe me, we all make them. I make them myself. So it's a great way to make it even and give your family a clean slate for the rest of their lives, because you have been able to repair all of those financial mistakes that would have put your family at risk. But through the use of properly structured life insurance contracts, you are now able to provide them guarantees and a lifestyle that they would not be able to get anywhere else. It is a very unselfish decision. I would argue it's the most unselfish decision that you could ever make, because on the death benefit side of the house, you're never going to benefit from it. But the people that you know, like, and trust, and the people that have been part of your life forever, will be benefiting for the rest of their lives. Now, one of the sad things that I find after 30 years of doing tax planning, retirement distribution planning, and insurance protection planning is that due to the lack of planning, the death benefit proceeds are seldom enough. I have never met, like I said, a widow that did not believe in life insurance. And I've never met a widow that said to me, you know, Bert, the amount of the death benefit is way too much. Many a times, sadly enough, it's not enough. Now, I have done my due diligence because I want to make certain that if I get sued at some point in time in the future and I get invited to a party that does not serve alcohol in front of a judge or a court, that I have provided my due diligence. So for every single client that I run and do an insurance audit for, I provide them with a human life calculation. Now it is up to them to purchase up to that human life value or anything below that. But my job is to provide them with all the tools so they can make the right decisions at the right time for the right reasons and under the right circumstances. Now, something that is also very sad is that most Americans will be disinheriting their family at some point in time in the future. And this happens quite a bit. I deal with a lot of public employees that decide to take the highest pension benefit, which will provide them the highest death benefit while they're alive, but upon their death, that benefit is going to stop. And then what they do is they buy term insurance to protect their family. But they don't realize that term insurance, has a beginning and has an end. So if it's a 20-year term insurance contract, in year 21, you have already disinherited your family, and you never thought about it as you went ahead and embark on that financial decision. So most of you will be disinheriting your family in many different ways at some point in time in the future, and I would imagine that that's not something that you wanted to do. But the road to hell is always paved with a lot of good intentions. So again, I can help everyone, but I can't save everyone. So that is something that I spend a lot of time with my clients and educating them and providing them, with the tools and the techniques to make certain that nothing like that will ever happen to them or their families in the future. For me, as a retirement strategist, an insurance professional, and a tax planner, the protection of the family unit must be guaranteed and without reproach. See, the wealthy are always thinking 2 or 3 generations down the line. Poor people are only thinking about Saturday night. So whenever I work with wealthy individuals, whenever we do any type of insurance planning, they're thinking about their children, grandchildren, and great-grandchildren along those lines. And they're able to purchase large amounts of life insurance. They put them in trusts. And then they dictate they can actually govern from the grave by putting clauses inside of those trusts that would allow the insured person that purchased a contract to dictate how those funds are going to go from one generation to the next and how those funds are going to be used in order to provide a supplemental retirement plan, in order to provide scholarships or education funding or business opportunities, whatever it may be. So always think that the family unit is the most important part, and every member of that family unit, so if you're married, both you and your spouse and your immediate children form part of that immediate family unit, and everything that you do from an insurance standpoint should be for the betterment and for the benefit of that family unit. I want to talk a little bit about needs-based versus human life value calculations. Most of the times that I do an insurance audit, I ask my clients as to, why did they decide to purchase the coverage? How did they determine the amount that they needed? And basically what they're telling me that it was all on a needs-based. Bert, I sat down with my advisor. He told me I needed $3,000 a month to pay my fixed expenses, and then another $2,000 to pay my variable expenses, and then we added a little bit of a buffer on top of that. But it's based on needs and not on a human life value calculation. The challenge with the way that most advisors and most Americans are purchasing life insurance today is that if you do it through a needs-based approach, how are you or your family going to know what your needs are going to be 15, 20 years from now, or 30 years from now, or 40 years from now? You won't know. So basically what you're doing is you're taking a calculated guess. Now, I'd rather you do that than not have any coverage whatsoever. But on the other hand, having a human life value calculation is most important, because by doing a human life value calculation, you do have the ability to truly identify what is the value of a human life based on your age, based on your professional background, based on your earnings capability in the future up and through retirement. So all of those things are going to come into play in determining what is the right amount of coverage to own based on a human life value calculation. Therefore, when you compare a human life value calculation to a needs-based calculation, then it is obvious that a human life value calculation is more robust. And you don't want to leave any money on the table, because at the end of the day, you want to make your family whole from a family protection standpoint. Now, life insurance provides an immediate funding base on a tax-free basis. So upon the death of a person, then once a death claim is submitted to the insurance carrier, usually within 30 days, at most I've seen it within 45 days, there's a guaranteed payment made. Now, in the old days, and even to this date, if you have a small amount life insurance policy, then they would send a check. It used to be that they would send it to the agent, and then the agent would deliver the check. Nowadays, if you have death benefit of, $200,000 and more, then basically what the insurance company is going to do is open a bank account and send the agent or send the insured or the beneficiaries directly a checkbook, in which now they have the ability to either write a check for the entire amount or treat it as a checking account in order to pay bills in the future. Now, another big thing about this death benefit is that it provides, like I said, an immediate funding base, because from there, now the surviving spouse can determine, how much of that death benefit they're going to use immediately, how much of it they're going to use in the intermediate range, and then how much of it will go into long-term range, how much is going to be taxable, how much is going to be tax deferred, how much is going to be tax-free, how much of it is going to be used to replace fixed expenses, variable expenses. So that's another conversation with the surviving spouse or the beneficiaries, and I'll do another video on that and what are some of the things that need to be paid attention to once a family member receives a death benefit. Now, it can pay medical bills. It can maintain the current lifestyle for the surviving spouse and children. There's nothing worse in the world than, having a family member, the breadwinner, pass away, and now all of a sudden there's no money left, and the surviving spouse either has to move somewhere else with his or her children that would be more affordable. The surviving spouse may not have a choice to go back to work immediately, instead of caring for herself or himself and the children, because of the pressures of not having any money to be able to buy time and assimilate what's going to happen now moving forward into a brand new life without that breadwinner or that person that was so loved and cared for by the family unit overall. So by having a death benefit, you can maintain that current lifestyle and not have to worry about much. But it does give you the ability to buy time so you can psychologically take care of yourself. It can also pay for education expenses. It can provide a guaranteed pension that you cannot outlive. So a number of the death benefit claims that I have delivered, and a number of clients that have received death benefit claims from other insurance companies that I did not manage for them, have reached out to me, and they wanted to create a guaranteed pension for themselves and their family. And I have been able to do that. So the versatility of having a death benefit proceed in front of you is something that is always very important at the worst possible time in your life, Because when everybody walks away from the cemetery or the funeral home, that life insurance agent or that retirement strategist or that insurance expert that provided those benefits to you and your family will actually be knocking on your door when nobody else will be. It also provides a surviving spouse beneficiary with a sense of purpose in life, because now you can think about what's next. You can think now a lot clearer as to what you can do, not only for yourself, but also for your family moving forward. The survivors actually control the financial outcome of their lives, and that's very, very important. The standards of living do not need to be altered when the breadwinner dies. You know, many a times I have found things with families that I have delivered death benefit checks to and checkbooks to that I was not aware that they had it because they never released that information to me. So by helping them have control of of that financial outcome would be a win-win. One of the major things I do tell my family members or beneficiaries of death benefit proceeds that I have delivered is that other than to maintain their standard of living, to park that money into accounts that they're not going to touch for at least 6 months. Because, and preferably a year, because any decision that you make within the first 6 months or within the first year, more than likely are going to be emotional decisions as opposed to rational decisions. And that's not something that you want to do with something so precious as a death benefit proceed. It can also replace Social Security benefits at death, as I have talked about before. Yes, the surviving spouse will assume the higher Social Security benefit, but he or she will lose one of the Social Security benefits because Social Security Administration is only going to pay one. So a death benefit proceed can replace that second Social Security benefit that the family had been so used to spending and use in retirement for a number of years. So I've talked a little bit about the importance of life insurance in life. I have talked a little bit about the fact that I have never met a widow that did not believe in life insurance, and that is a true statement. I have never met a single one. But now I want to talk about something that is sad, but it's something that I act upon right away, because there's always an imbecile in the house. I have done planning, or attempted to do planning, for families in which one of the breadwinners, and in a family usually you have two breadwinners, especially, you have a husband and a wife or partners in life, so they're both breadwinners. But I have heard stupid statements or imbecile statements as, Bert, once I'm dead, who cares? Now, that is a statement that when I hear, I just close my laptop and finish the meeting at that point in time. Actually, just about every statement I'm going to walk you through at this point in time will more than likely cause me to just shut down my computer and walk away or end the video conference abruptly, because those are not the type of people I want to deal with. I want to deal with people that care so much for their family and for their family's well-being that there's nothing that they would not do to make certain that they can protect them in case of a premature death. I have also heard, Bert, if I die, my family can figure it out. Now, how stupid is that? How stupid and what an imbecile statement that is. When I die, my family can figure it out. Really? How do you figure that out? As a matter of fact, I would argue that anyone that dies without life insurance should be given the opportunity to come back to Earth so they can see exactly what they have done to their family and all the challenges and all the tribulations that they're now putting their family through because they didn't think enough about protecting them, and they did a lousy, lousy job along those lines. I have also heard imbecile statements like, Bert, I don't believe in life insurance. Well, number one, life insurance is not a religion, so it's not something you have to believe in. Life insurance is a financial instrument. It's the type of instrument that is going to provide a known amount at a known time. Now, not only is that a stupid statement and an imbecile statement, it's a statement that it's a total lie. Because whenever I hear something like that, the first question I state after that stupid statement is, well, let me ask you this. If you could buy life insurance today knowing that you were going to die tomorrow, how much of it would you buy? You know, when I ask that question, 99% of the time, the answer that I get is, Bert, I would buy as much of it as I possibly could or possibly can. So in reality, it's not that you don't believe in life insurance. You just don't believe in paying for it and making an investment for the protection of your family. So whenever I hear somebody telling me that they don't believe in life insurance, I stop that meeting right away because I cannot fix stupid. I cannot fix stupid. And I've dealt with a lot of stupid people in my lifetime, so at my age, I don't need to deal with any more stupid people, so I stop that meeting and go home, or just shut it off completely. I have also heard, Bert, I'll just buy a 20-year term policy and my spouse and children should be all right. Well, obviously, hoping that your family is going to be all right just by purchasing a 20-year term insurance policy is not a financial outcome because you don't know what's going to happen. You don't know what's going to happen in year 21. You don't know if I had a case with a client of mine about 15 years ago, and the client was the owner of a plumbing company here in South Florida, and he had like $3 million of life insurance with me, so he had plenty of insurance, actually bought up to the human life value, but then he started to generate more money. And I said to him, I think it's important that we continue to bring it up to the human life value, so it would be important for you to purchase another $2 million. And he said, Bert, he says, with $3 million and my business and my son is in the business, my family's going to be okay. Why should I purchase $2 million? I said, well, because you cannot predict a financial outcome, especially in the future. So you don't know how your business is going to go in the future. I said, you don't know whether you're going to get sick. You don't know whether things are going to change and the financial world is going to change completely. You don't know if there's going to be a market crash or an economic crash and your business is going to stop at the worst possible time because no one ever dies at the right time. You don't know how many more debt you're going to have to get into. And you don't know what's going to happen to your children and grandchildren and so forth. So finally, the client went ahead and agreed to purchase the additional $2 million. And his daughter married an architect and moved from South Florida to New York City. And they had a beautiful baby, and the baby was autistic and Down syndrome. Now that baby is now a young woman. She's probably, I would say, 20 years of age, maybe 21 at this point in time, 22. And when he found out and the family found out, obviously they were devastated. He immediately called me and says, Bert, I want to thank you for giving me the opportunity and forcing me in a nice way to see the light and to get out of my own way by purchasing that additional $2 million in death benefit coverage. So what I'd like to do is I'd like for you to come with me to see my attorney so we can restructure these life insurance contracts, because I'd like to take that $2 million of death benefit and put it into a trust for my benefit of my daughter and my granddaughter, because my granddaughter is going to have challenges that are going to be there or not going to go away even after my son-in-law and my daughter pass away or I pass away in the future. So I can't thank you enough for thinking those things. So remember, you can never predict a financial outcome, and having the proper protection in place is paramount for you and for your family as well, and along those lines from that perspective. So what else? Oh, I have also heard, hey, Bert, you know what? I'm never going to experience a long-term care issue. And if I do, I have saved a bullet just for that occasion. Now, I hear that from my cops that are clients of mine. And that's not only a stupid statement, that's an imbecile statement. Because, first of all, how many of them do you think are going to commit suicide and end their lives at that point in time in the future? And number two, what if you have Alzheimer's and you forgot where you put the bullet? So how are you going to do that? So that's just an imbecile statement, because if you don't take care of it through the use of life insurance, your assets are going to have to take care of it. And then what's going to happen, since you're going to have to pay a lot more money to take care of those long-term care benefits, then you're going to go through those retirement assets a lot sooner than expected, and you're going to disinherit your family upon your death. And then the last one that I have heard in the past is, well, you know what, Bert? Once I'm dead, my wife will probably remarry, and she should be okay. Now, that's another imbecile statement that I have heard a number of times. Number one, that tells me that you really don't care about your surviving spouse, and you don't care about your family. Because forcing a surviving spouse to marry someone else, not because he or she wanted to, but because he or she needed to, that is really, really sad. And normally when I hear that statement, I would say to them in a question format, I would say, look, how would you have felt as a son or a daughter if your dad had said the same thing about your mom? How would you have felt as a son or daughter if your dad had said the same thing about your mom? See, in my case, my mom and dad were married over 50 years. My mom passed away before my dad, and my mom had a death benefit, small death benefit, $25,000, because my parents, were retired, that didn't need a lot of money. But the $25,000 came in very handy. Sadly enough, my dad passed away 8 months after my mom did, and he also had a $25,000 life insurance contract. And that helped not only each other while they were both, living. It helped my dad when my mom passed away, and then helped, my dad, or helped myself and my daughters and my wife when my dad passed away. And then the rest of the money came to us because I was an only child and full beneficiary of those assets. But can you imagine if my dad would have said to me, you know what, my son, once I'm dead, your mom can marry somebody else. I'm not going to worry about that. I'm not going to care about providing for her in any way, shape, or form. How do you think I would have felt? I would have been devastated. I would have forced my dad to buy a life insurance policy, even if I had to pay for it, in order to make certain that my mom was not going to be a bear and was not going to have to make financial decisions and personal decisions just because she did not have the financial means to be able to make ends meet in her life. So I'm hoping that I have given you a little bit of good information for you to ponder and think about, because life insurance is one of the most critical products that you need to have in your retirement arsenal, because no one ever dies at the right time. And like I said, I never met a widow that did not believe in life insurance. So if you want to pick my brain and reach out to me, feel free to call me at area code 786-766-1042. You can also send me an email at bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for you and your family is to kind of help you, like I've done in this podcast today, kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So thank you so much. Stay safe, stay healthy, and I'll talk to you next week. Take care. Bye-bye.